So on to today's speaker. Well, first of all, I do want to thank Invesco for sponsoring today's luncheon. Invesco is the world headquarters now for the company here in Atlanta, and with the recent merger with Oppenheimer Funds, they're now managing over $1.2 trillion in assets. Kristina is the Chief Global Market Strategist at Invesco. She entered the financial industry in 1995, and prior to joining Invesco, Ms. Hooper was the U.S. investment strategist at Allianz Global Investors. Prior to Allianz, she held positions at PIMCO Funds, UBS, and MetLife. You can see her regularly on CNBC, Bloomberg TV, and she's often quoted in the Wall Street Journal, Financial Times, New York Times, Reuters, and other financial news publications. Ms. Hooper holds the CFP, the CAIA, the CIMA, and the CHFC designations. She also serves on the board of trustees of Our Children, and previously served on the board of Jefferson Insurance Company and on the board of the Foundation for Financial Planning, which is the pro bono arm of the Financial Planning Institute. If you don't follow Kristina on Twitter, I would recommend doing so. That way you can get regular updates for her weekly Market Compass articles that she writes. And also she just wrote an article on LinkedIn on why we must rethink recruiting in the financial services industry. It's a very timely, highly relevant article for this time. So with that, I'd like to introduce Kristina to the dais.
Good afternoon. It is a real pleasure to be here. Thank you so much for having me. This is a small enough group that I would encourage you to make this interactive. Feel free to ask me questions as we go through this presentation. Feel free to challenge me. One element of my bio that didn't get read is that when I was going through NYU Business School, I was a teaching fellow. I was a TA to pay my way through, and so I'm used to being heckled and otherwise abused by undergrads, so feel free to do the same. I also am the mother of teenagers, so that's even more brutal. So feel free to interrupt as we go through this, question me, ask, feel free to share your comments, and we'll also do questions at the end as well. But let me start by sharing this slide with you. What we tried to do with this slide is plot countries' composite PMI relative to where they were a year ago, and also in absolute terms. So let me explain. So this is expansion, this is contraction, and anything to the left of this line has deteriorated in the past year. So you can see that the majority of economies have deteriorated in the past year. The only one that deserves 2 plot points, because we're focusing in on it, is the US. And you can see a deterioration even in the US over the course of a year, even though the economy has been relatively strong when we compare it to a lot of other economies. I throw this up there to share that economies are deteriorating in general. I would argue that if we were to dive down, and let me just pull ahead to the slide, if we were to dive down into the composite and look at manufacturing PMI versus services PMI, a very powerful theme emerges. It's manufacturing that is pulling down the composite, right? That's, for many major economies, already in contraction territory. And in the US, we just saw the most recent ISM manufacturing pulled into that contraction territory. So this says to me that so much of the economic deceleration that we've seen over the past year can be attributed to the trade situation. That's really what has put downward pressure on the global economy. But let's go back to a few themes beyond just that. And in fact, we're in a state of disruption that I think we've been in for several years now. It's a result of really the global financial crisis and our reaction to that crisis. In particular, our over-reliance on monetary policy as opposed to fiscal policy. Interestingly, it's a theme that we're still seeing this day. But The initial reaction, that sort of QE on the part of some major central banks, I think really, along with very low rates and in some places negative interest rates, created an environment where today, or at least in 2018, we tried to unwind, and that proved to be an experiment. Unwinding an experiment is an experiment in and of itself. And of course now we've got normalization on hold. It appears that we're moving in a very different direction in terms of getting more accommodative, which I'll get into in a minute, which raises the specter of whether or not we'll have enough dry powder for the next real crisis. But we also are in the midst of geopolitical disruption. One byproduct of over-reliance on monetary stimulus is that we saw wealth inequality grow. Because monetary stimulus, it's a blunt instrument. It's not a surgical tool, so it doesn't directly impact the economy. We can lower rates, but we can't force banks to lend, and we can't force households or firms to borrow. So quite often, and this was certainly the case in the global in the wake of the global financial crisis, what we saw was the greatest impact was on asset prices. And that's why we saw such a weak recovery for the economies, the major developed economies around the world. So that has created a rejection of the status quo, populist movements in a number of different countries, and I think is part of why we're seeing this economic nationalism today that is essentially embodied in trade wars and other protectionist activities and looks likely to continue. And then finally, we're also in the midst of a fourth industrial revolution. This is a much longer term theme, but it is adding to economic anxiety and insecurity. And it's really evinced in seeing Americans who have jobs, who are doing well, but are nervous about the future. And certainly some of that is immigration and some of that is automation. And I think automation is going to be a bigger issue going forward. We're certainly hearing candidates start to talk about the concept of basic income. I think that's going to be a bigger part of the debate as we see an erosion in jobs because of automation. Now, one could argue that given demographics, that actually is probably a good thing when we have labor replacing innovation in an environment where demographics are expected to decline soon. But we have to recognize that there is a level of mismatch probably in the next couple of decades, and that could create a pretty significant rise in structural unemployment. Just for one example, if we look at driverless technology, I mean, it's clearly happening. It will take years probably to see in the United States, but it's already being tested. And we know that driving as a form of employment is actually represents, I think, 4% of working Americans are employed in a driving function, whether it's taxi driver, Uber driver, bus driver, truck driver. So if driverless technology becomes ubiquitous, we have to worry about the potential for a pretty significant rise in structural unemployment. That may not be a problem for some states, but for other states where driving as a profession is one of the top 10 sources of employment, that could be a real issue. So I think that's why we're probably going to see more in the way of basic income. Yes?
That 4%, is that for employees or is that for income?
4% of employees are employed driving, between bus drivers, truck drivers, etc.
And is your average income greater or less than the average? The question is it going to have more of an impact because you're higher paid than average?
Well, I don't have the breakdown for you, but I will tell you that truck drivers are making significantly more. Uber drivers bring down the average, of course. Some are on public assistance, but truck drivers, in the last few years, we've seen average salaries on a daily basis of near $100,000 in some states. So it really depends. So let me dive down into the more immediate themes of monetary policy disruption and then geopolitical disruption. So in the United States, of course, we have a situation where it appears that the Fed is attempting to combat trade wars with monetary policy. And I say that because if we were to think about the economy, it's relatively strong. One would not assume, based on the current economic data we're seeing, that the Fed would be loosening policy. In fact, one would assume the Fed would be tightening policy. And in fact, they characterized the last 2 rate cuts as insurance cuts, right, to prevent an economic downturn presumably caused by trade. And so that creates a pretty difficult situation to be in. First of all, in terms of a mismatch in expectations, because I now believe that the stock market is reacting to negative trade news. For example, a couple of weeks ago, what we saw was some negative trade news flow followed by a very significant increase in expectations of an October rate cut. So there's a mismatch in expectations, I think, and a fair amount of confusion around current monetary policy. But we also have to recognize that the accommodation we provide now is an erosion in the dry powder that we could utilize in the future. So the Fed is in a difficult position. Part of the problem is that we probably need to explore new monetary policy tools. If we think about monetary policy regimes prior to 2008, it was a very ordinary set of tools. And essentially it was the Fed funds rate. Now, we did have Operation Twist in the early 1960s, but that was really an aberration. Then, of course, 2008 on, we began relying on QE. The history of QE as a tool is very limited. In fact, the idea behind it, large-scale asset purchases by central banks to manipulate rates on the long end, was just an idea from an economist on President Kennedy's Council of Economic Advisors named James Tobin. So for those of you who remember your finance work, Tobin's Q is what he's best known for, although I think at the end of the day he'll be known as the father of QE. But his argument was that had the Fed utilized large-scale asset purchases during the Great Depression, the country would have gotten out of that economic situation sooner. So now QE has become a very standard tool. Certainly for the ECB, they're already falling back on that almost immediately after ending QE last year. And so we have to recognize that this is, that the effectiveness of these tools is deteriorating, and that this could be a time when we actually see central banks exploring even more experimental monetary policy tools. And that takes me to the ECB, where I think the ECB is probably the best candidate to explore even more experimental tools. We're in a situation now where the ECB just put Europe deeper into negative interest rate territory, right, with the cut in September. Now, there are a lot of really negative knock-on effects from NERP. In fact, when I was in Austria back in March, I was really surprised to find that there's a large cohort of households with mortgages that are now suing Austrian banks to try to get them to pay them for the mortgages because it's a negative interest rate environment. So there are a lot of negative effects that I don't think were contemplated in those in the years after the global financial crisis, as central banks were attempting to respond to the crisis. Also, I think that Christine Lagarde is such a non-conventional ECB president that she would be most likely to explore tools. And of course, what we're hearing from a lot of central bank heads is that governments need to spend more. What we really need is fiscal stimulus, not monetary stimulus. But so far, Germany hasn't loosened the purse strings. In many countries, there's just not a willingness to fiscally stimulate. So I suspect that the new frontier for monetary policy tools will be those tools that simulate fiscal stimulus. And by that I mean helicopter money. As much as that's sort of an obscure concept and one that hasn't been treated seriously, I suspect that someone like Christine Lagarde will be the first to actually consider it seriously. Now, just as an FYI, Mario Draghi has been asked about helicopter money intermittently, really since 2015 in his press conferences. He's always been quite dismissive, said the central bank hasn't explored it. I do suspect that that's the next frontier, because current monetary policy tools are likely to continue to exacerbate the knock-on effects. Yes?
Could you explain, please, what helicopter money is?
Sure. Well, helicopter money, I should explain, is a very amorphous concept. It's the idea that central banks inject money into the economy. So, of course, one can assume that they're indirectly impacting the economy through traditional policy tools. But this is a way to actually inject money into the economy directly. And so a few different ideas have been entertained by various academics. One is the idea that you actually wire money into individuals' accounts. And actually, this was an experiment done in Australia where everyone got $900. I don't know why, 900 Aussie dollars. But there has to be, though, an incentive to spend it. Otherwise, it doesn't make its way into the economy. And of course, what we know when we look at global savings and investment balances is that, up until the 1980s, we were under saving and we were spending too much on investment. But that's why economies grew so much. 80s, 90s, 2000s, we had a pretty good balance between investing and saving in terms of corporations and then 2008 on, what we've seen is this huge imbalance where companies are just saving much more than they're investing. And so if we were to give money, we would have to worry that households would save it rather than spend it. So there's been talk about the idea of having an expiration date on the money. So if it gets wired into your account, you have to spend it within a month or it disappears. I honestly think that that's a pretty ineffective way to get money into the economy. I think that what we really need to see is money directed toward infrastructure spending. If we look at the history, in fact, I'm a student of the 1930s and the Works Progress Administration in the US. If you look at what was done, not only was the economy stimulated, unemployment came down, but infrastructure was built upon which commerce and education could occur for decades. LaGuardia Airport was built by the WPA. Now, it's disgusting and of course needs to be renovated, but think about all those decades when it was used and certainly was a benefit. The high school my mom taught in was built by the Works Progress Administration. So there's a lot that can be done with infrastructure. So taking helicopter money, essentially having a central bank just take money and spend it on infrastructure projects is one way it has been contemplated, and I think that's the greatest ROI. Yes?
So at first I was going to ask about cash for clunkers, because that seemed like a good model for giving people money, right, and getting them to spend it. But when you're talking about trying to get a monetary authority now to finance infrastructure projects, it just seems like that just gets so bogged down in all kinds of local requirements for diversity, for environmental studies and all, but on the other hand, I see the merit, but I'm just confused on how exactly something like that would work.
Well, keep in mind, these are all pie-in-the-sky ideas. So I'm only relaying to you what some academics have considered. But you're right, it does present a lot of issues if you were to take the route of infrastructure projects. In fact, for those of you who remember in the global financial crisis when the government did spend, it was an $800 billion shovel-ready projects, if you remember. But what wound up happening is because there are so many environmental impact statements and all kinds of bureaucracy, we typically saw that in many areas, highways that had been paved a year or two earlier were just repaved because the environmental impact statement was already in place and it was easy to do. So it was a way to just throw money at the economy and give people jobs, but it wasn't productive. So yes, it would be a hassle to do a real infrastructure where you're building new things. And maybe it could be something like a central bank government partnership. But the idea is to have the biggest bang for the buck if you are going to do something like that. Now, I've said all these positive things about it, but the negative is that that's an encroachment of central banks on what is typically covered by governments. And so that would be problematic, and that's why you probably see something much more downscale, like electronic payments to accounts. I just don't think it's as productive, but it's probably going to be easier to do in the grand scheme of things. Because one thing one other issue we're running into is that after about 3+ decades of central banks, even emerging market central banks enjoying great independence, we're seeing an encroachment on that independence. And some of it is just that we're seeing populist movements. And if you think about central banks, they are one of the last bastions that populists would probably enjoy taking down. It's academics and experts making big decisions really far removed from the democratic process. So to add to that more power in terms of infrastructure spending, I think would be problematic. I think you can get away with it in Europe, just because of the unusual structure of the European Union, where it's a monetary union but not a fiscal union. So you have Germany, which everyone is begging to spend money, and maybe they will now that it looks like they're headed towards recession, but they've always been very reluctant to spend, but they've enjoyed the benefits of being part of a monetary union, where, of course, the currency is depressed. So you can sell more Mercedes, more BMWs in an environment like that. So I think it could work there because the governments don't want to spend, and because there's a gray line between governments and what is done by the overall European Union and other entities like the ECB. All right, well, let me move on to what I think is the biggest issue with the trade situation, which is economic policy uncertainty. A lot of the first analyses that I saw done when the trade wars began was sort of a poo-pooing of the situation because it really doesn't impact that many goods. The tariffs aren't that big. My concern always was not that direct impact of those specific tariffs, but the environment of economic policy uncertainty that it creates. And that's what we see in this chart, is that economic policy uncertainty globally has risen far more than it was during the global financial crisis or even Brexit. And why do I worry about that? Well, because what we've seen historically is a direct inverse relationship between economic policy uncertainty and capital spending, business investment. And that's a real problem. And in fact, let me take you to this slide. Right now, the UK, in the midst of Brexit, is the poster child for economic policy uncertainty. Now, I threw in the global financial crisis just so you can see the quarter-over-quarter growth rates. And obviously, this is bad. But what you see is that after the Brexit referendum, we're just not seeing the level of business investment that we've seen in a more choppy fashion in previous years. And so that suggests that the longer the situation goes on, the less we will see in the way of business investment. It makes sense. When companies don't have visibility on the future, they don't want to spend. And so whether it's Brexit or trade wars, it creates some significant problems. And that's why I think, even though the tax reform package was a real positive, especially that component of it that incentivizes CapEx spending, we haven't seen the kind of CapEx spending that most would have expected. And I think it's because of the trade wars. So I talked a little bit about that theme of governments not spending, and I just wanted to give you a few slides to show this, and especially why Europe is ripe, I think, for monetary policy tools that simulate fiscal spending. So what you see is deficit spending as a percentage of GDP. We're comparing the EU to the US, and as you can see, the EU is just not stimulating enough. A lot of this, again, has to do with Germany. Tax rates are not where they should be, given that the economic growth in the EU is quite anemic. And also add to that the problems of Europe's relationship with China. Typically, China is the engine And the European Union is the caboose. When we see China experience a deceleration in growth, usually with a lag, that's what we then see for Europe. And that's what we're seeing now. And while I talked about the benefits of a monetary union that's not a fiscal union, there's some real problems with that. And that's because the countries in the European Union are so different. And I just pulled up one metric that I think really exemplifies that, and that is youth unemployment rates. So you can see Germany, the Netherlands have very low youth unemployment rates, but the peripheral countries all have unemployment rates above 30% for youth. That is a huge difference and really speaks to the fact that it is very difficult to have policies that apply to all countries. And that's why we're seeing Italy really bristle, although things seem to be better now with the coalition government. That's why we're seeing Italy really bristle, because the same covenants that Germany puts upon itself in terms of what kind of a budget deficit you can run on a yearly basis, what kind of total debt you can have. It's a lot harder for Italy to meet those same covenants. And of course, that makes sense given how different that economy is and the more headwinds facing Italy. Japan also is in a somewhat similar situation where we're seeing less government deficit spending and higher tax rates. I was just in Tokyo all last week meeting with institutional clients, and the October 1st consumption tax had just gone into effect. And there were a lot of concerns about it. And so the assumption is that, in particular the fourth quarter, we're going to see deterioration in growth given what's happening. Japan should be fiscally stimulating, not actually fiscally tightening. Then, of course, and I should say a little bit on Japanese monetary policy. If you ever do worry about U.S. monetary policy, especially the lack of dry powder that I talked about, if you want to feel better, look at charts from Japan, because what you see is that while we drove up our balance sheet from 800 billion to 4.6 trillion, it's nothing compared to the Bank of Japan's balance sheet as a percentage of GDP. Also, while I said I'm worried that we won't have enough dry powder, there's absolutely no dry powder in Japan. So again, if I were to think about the next frontier for monetary policy tools, I would assume it starts with the ECB, but it could catch fire in Japan, just given where we are today. When you have banks and investment houses creating investment products specifically for the Bank of Japan to buy as part of its quantitative easing, that's when you probably have to worry a little bit. And that's happening. And then there's China, which is a little different. What we've seen is that China did a very good job stimulating out of downturns in 2010 and 2013. And then it turned its attention in recent years to deleveraging. But then the US-China trade war happened. And so what we've seen is an about face, a pivot on the part of China to start spending more. And you can see as a percentage of GDP, they're now spending more than the United States, and we're profligate spenders. And China actually also had a tax cut. China is going to be choppy, but what I will tell you is that China will do everything it can in terms of monetary stimulus and fiscal stimulus so that it does not lose the trade war. And by lose the trade war, I mean it's willing to do whatever it can to sustain its economy at a relatively good growth level, let's say 5.8 to 6% if we want to talk in terms of official numbers, and ride it out rather than make any major concessions to the US. This has been my view really since the start of the trade wars, and it hasn't changed, and I think what we've seen in recent weeks in terms of developments bears that out. There's just a lot of tools that China has at its disposal. President Xi is president for life, and he has many more levers of the economy that he is able to control versus a country like the United States that's a democracy. So let's turn to the US. I mean, one of the questions I'm sure that is on many minds, of course, is whether or not we go into recession. The number one issue that people point to in terms of suggesting that we could go into recession is the yield curve inversion. Just a few things, and these are pretty obvious, but of course, QE has distorted treasury markets, and one could argue, I think, quite in a very compelling fashion, that the yield curve inversion may not be an accurate predictive tool anymore because of that. I think it's also important to note that typically when the yield curve inverts, the 2 and 10, it's most predictive when its inversion lasts 3 months or more, and we haven't seen that, of course. And finally, usually when the yield curve inverts and it results in a recession, it's because the Fed is tightening and the short end is moving up, causing the inversion. But that's not what happened this time. Remember, in July, the Fed actually cut rates. So what we saw was the yield curve, the short end go down, but the long end then follow and move down even more. So a different situation, it may not be as predictive. In any event, even if it is, we know there's a pretty significant lag time between when the yield curve inverts and when recession occurs. The average is 21 months over the last 5 recessions. The shortest is 10 months. And so that suggests that we have time. Our view, our base case, is that in the next year we will not see a recession in the US. We also don't expect to see a global recession. Of course, we're watching this carefully, and I'll walk you through a few of the metrics that we're looking at. Obviously, oh yeah, please.
When you say global recession, you're saying below 2.5% growth, or you're saying below 0?
Below 0.
Don't you think that when we look at the world and the interest rates, and we have inflation at 1.8 in the United States, and all the 10-year and below are below that rate, isn't that negative yield? I mean, why do we define negative yield as 0 when we know we have inflation?
That's a good point, but
how do we keep saying that we think cutting rates is going to be strengthening the economy when in reality there's got to be some margin? I mean, when you model it, when you reach some point where it's not a one-to-one relationship,
it's losing its efficacy.
Haven't we already hit that point?
I think so. That's why I think it's time to explore other tools. Perhaps in the United States, we have some room to go, but absolutely. I mean, I think that's absolutely what you hit on, and what I'm trying to really share in this presentation is that that's something we do have to worry about. It is. One size also doesn't fit all. A recession in one economy is not going to be the same as a recession in the other. But let me focus in on the United States, and maybe I can sort of come back and move around to the global. But of course, in the United States, we're the most consumer-driven economy, and of course, what happens with the consumer is critical. That's why we follow the job market so closely. So everything looks quite good, but we have to recognize that a lot of the metrics we look at in terms of labor markets are lagging indicators. I will say, just by way of comparison, I presented a lot of negative things about Japan, but one thing I shared with them when I visited institutional clients last week and sort of shared the state of the U.S. economy. So the one thing we do have to worry about is that if the labor market were to see any kind of deterioration, it would be more problematic than in other economies because there's so little in the way of savings in the United States. And of course they said, no, we look at the statistics, the savings rate has gone up. But the savings rate by income level, by asset level, is just so different. And so I'm sure some of you have seen the studies, like 44% of Americans wouldn't be able to handle a $500 emergency expense. That suggests a fragility in the consumer, even though they're employed, even though that they're spending. And so that's why the labor market is so critical. Now, do we see signs that companies are going to pull back anytime soon? No, but I will tell you that on a lot of earnings calls, we're hearing, and we've now heard, I think for 2 quarters now, talk about recession planning. And what that might entail. Companies are hell-bent on protecting, really defending their profit margins, especially those companies that are feeling cost pressures with input costs going up from tariffs. So a lot of the industrial companies, manufacturing companies, in particular, I think what we could see is a continued deterioration in business investment, but at some point that has spillover effects, and we see it actually impacting the job market. And that's what we want to look for. We haven't seen it yet, but that's kind of the doomsday scenario in terms of what could really create an unhinged economy, because the consumer, even though employment is in such a good place, the consumer is quite fragile. The consumer, the sort of the lower income, even some of the lower middle income consumers. Now, there are some, oh please.
Isn't there a lot more sensitivity in a downturn? So we've got sticky wages on 44%. But if you think about the other part of the economy, it seems like there's generations now are compensated so much more by bonuses than by salary that you don't have to have a layoff in order to reduce your expense, and that it could actually perpetuate a slowdown because they'll protect their profit margins and cut bonuses and compensation. And so it seems like that's a real...
I think that's a great point. I think typically what we see in that cohort is a much higher savings rate. So it's not going to have the kind of immediate effect that you would see even if hours are cut. Now we do, we want to follow hours, of course, because that's often the first indicator. But even if hours are cut, that can be really problematic for lower income consumers, just because the savings is not there. So that I would say definitely, if it lasts, a significant amount of time, that becomes a problem. But I think the bigger problem is with lower income Americans. Now, the composition of debt has changed somewhat. In general, what we see is household financial obligations going down. Mortgage debt has gone down. That's really been a phenomenon since the global financial crisis. And of course, it's compounded by millennial habits, since they're not as interested in owning homes. But what we've seen is an increase in student loans and an increase in auto loans. Not really problematic with the, in terms of auto loans. Certainly there's a segment of auto loans that we're actually seeing default rates that are high, but I don't think it's any cause for alarm. What I worry about more is student loans, not today, but just in terms of the impact on household formation. So it doesn't speak to the fragility of the consumer in the next year. This is more sort of the longer term thing that I think we have to worry about. Yes?
So you're talking about the type of debt that people hold and a little bit about the amounts, but you could almost say that the underwriter has changed more than the amount and the type. So it's the government that holds student debt. It's the government that holds a lot of the house debt. And I wonder if that matters on there.
That's a great question. Well, I think what we've seen is a real cleanup in the mortgage market, so I don't worry so much about that. The student debt issue is a much bigger issue from my perspective. Some of it has to do with the egregious interest rates that are being charged. It's shocking to me. I just assumed, I graduated from college in 1992, so I'm old, and when I graduated, my student loans were 5.75 to 6.75%. And I remember when my husband and I got married and we got our first mortgage, it was right around that level. So I always assumed, once I paid them off, I didn't think about it again. I always assumed that as my mortgage rates came down and I refinanced, that the student loan interest rates would come down as well. And then a friend of the family who graduated from medical school asked me to help her figure out how to pay her student loans. And I said, just give me the documentation, I'll go through it. And I'm thinking, 6.25%, 6.75%. She had one private loan for 7.25%. How could that be in an era of financial repression that we haven't passed on those savings to students? So I think one real problem, but that's an easy fix, is adjust the interest rates on student loans, because that takes a huge burden, especially for those, and many students have to go through periods where they can't pay and the interest accumulates. So that's a huge burden. And then the other thing is that student loans are the one debt, of course, that you can't dispense in bankruptcy. So the government doesn't have to worry as much about that debt than others.
Well, but I'm also asking too, they're the ones that are doing the government's doing the foreclosing. If the government is being mortgage underwriter would be the forecloser instead of the big bad banks and instead of the mean. I wonder if they can have the will.
I don't know, that's a good question. I think a lot of it depends on the future of the administration and things like that. I think it's going to be a high-level decision. Oh yeah, please.
As an alternative to helicopter money, wouldn't it be easy to just forgive student loans? And, you know, I hear that phrase a lot, people don't like to buy homes, et cetera, but I take exception to it because it's not that they don't want to have a home, it's that they can't afford it because the student loan debt is so high and the housing prices are also high, and the salaries have stayed, you know, especially starter salaries have stayed pretty even. So I guess my question is, wouldn't that be an easy way to helicopter money to the very people that are trying to get spent, particularly on housing?
I think you raise a good point. And I think that if helicopter money is treated seriously, and it hasn't really been treated seriously, especially in the US, if it is, I'm sure that would be one of the proposals. You could also see, depending again on the administration, that you know, whatever the future holds for the country, you could see them contemplating paying down student debt with government money if Congress approves it. So there are a few ways to go, but you're right, and thank you for pointing that out. I didn't mean to say. I heard like millennials don't like bars of soap too, so I should probably stay away from those gross generalizations. As I was in my hotel room this morning using the shower gel, I was like, oh, that's right, because millennials don't like bars of soap, so I didn't mean to be disparaging. Okay, so, you know, credit delinquency rates look good. Again, household credit card debt looks good. So we're in a good place. I would just give that caveat, you know, the footnote that I worry about the fragility of a large portion of the American consumer. So when we look at businesses, things look fairly good from a corporate standpoint as well. No real issues there. You know, there are some, you know, there are particular statistics that will scream out, and so loan demand has gone down. But all in all, I think it's a fairly positive picture. So, what are the longer term themes I'm thinking about as well when I think about the U.S. economy? Well, certainly government debt, right? We're running trillion-dollar deficits now. And of course, what we're seeing is just a significant burden being placed on the federal budget just in terms of servicing our debt. And that's one reason why I think it's going to be very difficult for the Fed to raise rates very much. And while we won't see it in any FOMC minutes, it has to be a consideration. Right now, the fastest growing line item in the federal budget is interest expense. And that's at a pretty low level. So when the global financial crisis, you know, as it was beginning at the start of 2007, the Fed funds rate was over 5%. So some could assume that that would be normal. And there's no way we can get back to that normal. It would just be too onerous, especially since demographics are not on our side. You know, with an aging population, we're just going to see more in the way of you know, sort of government expenditures. In fact, interestingly, in Japan, the government has really focused in on demographics, obviously a much bigger problem for them. And they say that really when people hit 75, that's the start of the big expenses for the Japanese government. And I suspect that it's actually a lower age in the United States because we're not necessarily as health conscious. But what do I know? So just throw that away. So just a little more in the way of our deficit and debt on the rise. Interestingly, the Congressional Budget Office puts out projections in terms of where it sees debt 10 years from now. And so we're at 15 trillion now. The estimates are we get up to like 28 in the next decade. So think about that kind of burden. It's going to be very hard to raise rates very much in that scenario. But let me turn to trade policy, since that's my big concern right now. And I would just say that in general, we're seeing some trade policy errors. And in particular, I worry about how we've undermined the World Trade Organization in the past few years. The WTO, make no mistake, is an incredibly flawed organization. It takes a very long time to adjudicate cases. We just won a case that I think was brought more than a decade ago. So trust me, there's a real need for reform. But it's one thing to reform an organization, it's another thing to cut off its knees. And that's what we've done. We've blocked the appointment of appeals court judges. And that can be a real problem because we now have this huge bottleneck of cases, including cases that we've won, that in the lower WTO court, we won versus China, and now we can't implement because they have an automatic right of appeal. They can't appeal, and so it sits waiting. Just in general, I think the approach to China has been problematic because we lack a prioritization of key issues. There's been so much focus on narrowing the trade deficit, and that's really irrelevant. The key issues are access to markets, that forced technology transfer, intellectual property protections in general. Those are the big issues, and they've become so confused by focus on narrowing the trade deficit. And China has taken advantage of that, and I think part of it is that there have been different camps of the administration, and they have worked at cross purposes. But the result has been that we haven't seen any kind of meaningful progress. I know we have this mini deal on the table, or at least the U.S. thinks we do, China not necessarily. And so, it could be that we just exist through a continued period of economic policy uncertainty. And it's unfortunate because, we had the tax reform package that really was a stimulative piece of legislation, and so much of that is being countered by the economic policy uncertainty created by this. I will also say, just in general, when you have to shift supply chains, you lose that comparative advantage if it's that forced kind of shift, as opposed to one created by free markets. And so we do have lower efficiency and productivity, and so it's a problem. I think we're also going to get deeper into a tariff dispute with the EU. That seems to be where we're headed going forward. And of course, there are spillover effects into foreign policy. I think part of why North Korea has been quite aggressive with us is because of the breakdown in talks with China. China was sort of pushing North Korea to be more cooperative in the past. The stakes are high because international trade as a percentage of global GDP has grown quite significantly. If you think about the last major trade wars we embarked on, it was in the 1930s. International trade was a much smaller percentage of world GDP. So the stakes are higher, and I think we just need to recognize that. Again, I'm not doing any ads for the WTO, but I will say that the average tariff rate for WTO members over the course of the last 2 decades has come down significantly, from 12.7% to less than 9%. Not perfect. In fact, the WTO needs a lot of reform. Unfortunately, though, we've stepped away from it and refused to be part of it, and so China is having an outsized control over the kind of reforms that the WTO is working on right now, which I think could be very problematic. This is just a little chart on what I think are the negative consequences. But we're seeing demand destruction. What we're seeing is reduced profit margins. This actual, I love to read the Federal Reserve Beige Book just because of the kind of anecdotal information you get from it. Quite often it gives you layers that you just don't see in data. And what we've heard for a year now is that input costs are going up, and they're creating some significant pressures on certain companies. And we're seeing specific companies talking about issues in their earnings report. Last fall, Fastenal was talking about the disruption of the supply chain. More companies are talking about that now, but that was sort of the canary in the coal mine for us. Now, some might think, it's no big deal, this disruption of supply chains, but I love what Cato Institute has said about it. And of course, they're huge advocates for free markets, but they liken the kind of tariffs that we're seeing to in the 21st century to building a wall across a factory floor in the 20th century in terms of how disruptive that can be. And I think that's true. Economic policy uncertainty in the U.S. is not what it is globally, but it is the highest level since the global financial crisis, just as an FYI. But what I thought was interesting was to go through the most recent earnings calls to see what companies are talking about tariffs. And I assumed that it would be the industrial, the manufacturing companies talking the most about tariffs, especially since none of the tariffs on Chinese sort of consumer related goods had gone into effect during those earnings calls. But in fact, retail companies were speaking the most about it and were really concerned about it. So we'll want to follow that closely, especially given the potential impact on what I think is a somewhat fragile consumer. But that just helps give you a sense of what is being impacted by it. So CEO confidence is on the decline. Cap goods orders are indicating weakness. Small business expenditures, I would assume they would be pretty isolated from the trade situation, but we're even seeing an impact there. Now, why do I think that China has the ability to outlast the United States? Well, one reason is that they just have more tools at their disposal. I talked about that mismatch. She is president for life. President Trump is president for a 4-year term and has to get reelected. She can control more levers of the economy than President Trump can. But let me just give you a few different tools or weapons that China has in its arsenal. They've got the ability to, of course, stop defending the yuan. All kinds of different things. Encourage North Korea not to cooperate with the U.S. But what I think is the real concern, and I've been talking about this now for over a year and everyone thought I was crazy, but the potential for a rare earth metals embargo. In the early 1990s, that was the last time a U.S.-owned company, owned a rare earth metals mining operation. And they decided to sell it, and a number of State Department officials went and lobbied the president, asked that they please not sell this to a foreign government because of the national security implications. Because rare earth metals not only go into smartphones, but which was, of course, not a big deal at the time in the early 90s, but they went into all kinds of missile defense systems. Radar utilizes rare earth metals. So they asked that the U.S. block the sale. The U.S. didn't block the sale. And as a result, China now controls over 80% of the rare earth metal mining market, which has implications, of course, for smartphone manufacturers, but also U.S. Missile defense systems. And so this is something that one presumed China would use as a tool, but they never said anything until recently. Now we're seeing references in Chinese Communist papers to the potential to use that. So something to think about. So what about the investment implications of all this? We kind of sort of had a pie in the sky conversation, but what we like to do when we think about asset allocation is to first decide where we believe economies fall in terms of the economic cycle. And you can see the majority of these countries fall in that late cycle. That's where they're clustered. Now, you might take issue with where they are, and certainly we're reevaluating this just given that what we're seeing with monetary policy accommodation really runs counter to what we usually see in late cycle, right? A typical late cycle means central bank tightening. It also means we've got inflation rising, which just doesn't happen, which isn't happening. We haven't really seen signs of that. So this is, from my perspective, a bit of a rule of thumb, but not particularly helpful today. And so the way I like to think of it as, you might think in the U.S. you're in the 8th inning and the game's going to end soon. But because of what's happened with low inflation and with central bank getting more accommodative rather than tightening, is that we could be in it for 13 or 14 innings. So go buy more popcorn, wait around a while. Now, for some economies, that central bank accommodation really won't matter because we talked about that growing ineffectiveness of current tools. So one size doesn't fit all when we think about this. But what I will say is that I think there's just going to be more of a melting into recession, and perhaps a more modest recession, at least for the United States. Now, when we look at this, what we see is that typically equities, industrial commodities, and REITs perform well late cycle, no matter what the economy. And I would expect that we see equities continue to perform well. In fact, if I were to pinpoint one, the biggest impact that monetary policy accommodation has, it's on the stock market, right? And I think that helps buffet any slowdown or any downturn in stocks. But when we get to, but at a certain point, we're going to bleed into that recession, probably slowly and modestly. So we want exposure to investment grade credit and some more safe haven asset classes, if you can call them that. But this is in general what we're seeing in terms of the environment. And again, we would look to REITs as well, especially given the need for income in this environment. Let me just show a few different thoughts, give you a few different thoughts with a few different charts in terms of historical perspective. So in terms of yields, what we tried to do was plot the very long term. So this is actually from the 1970s for equities, not as recent, more recently for real estate. Government bonds, we go back to 1985. But what we're looking at, global yields within historical ranges. And it's really stunning how for cash, government bonds, corporate bonds, we are at the very, very low end of the historical range. And some of these ranges are quite long. Whereas equities, we're not at the low end of the range. We're a little below average, but we're not at the low end. And so that says to me that what we need to do is look to multiple sources of income. We can't just focus on government bonds and even corporate bonds. We're going to need to move out on the risk spectrum to get our yield. If we look at CAPE from a historical perspective, what we see is that the big buys are coming from Japanese equities, but of course you could argue there are reasons for that, and emerging markets equities, whereas the US looks overvalued. What we know is that a reversion to the mean never happens overnight. So I would expect US equity outperformance to continue for at least part of 2020, but we're likely to see a slow slide there as other areas, in particular I think emerging markets equities, outperform. EM, keep in mind, had a huge headwind in terms of balance sheet normalization. It created a liquidity suck. And because normalization has ended, I think that is going to give breathe a little more life into emerging markets equities. Also, what we've seen historically, and I apologize I don't have the chart, but EM business activity tracks very closely EM equity performance. We had a breakdown of that relationship over the last couple of years, I think largely because of that liquidity suck, but I expect a reconvergence there, and EM business activity looks fairly good right now. So I know I've covered a lot and meandered a bit, but let me stop there and see if you have any questions for me. Yes?
I was wondering whether, as part of your macro analysis, especially in Europe, whether you follow the increasingly large trade imbalances within the ECB system, primarily the target 2.
Yeah.
Is that something you look at?
Yeah, we've talked about it. I mean, we don't have it as part of our model, but we've talked about it and the fact that there's probably going to be need for reform. This is something that the Fed handles quite easily, and yeah, we've talked about it, but it's not part of our framework. What are you concerned to? Do you want to?
Well, you mentioned Italy and
Yeah.
Germany earlier, and I think right now we're about $1 trillion. Italy owed to Germany, and so if ever there was tension and the country would leave the Eurozone, there's potential for a big blow up, basically.
Yeah. I mean, I worry a lot less about Italy today than I worried about it a month ago, but I think you make a good point. I think this is very ripe for reform. Yes?
This may be a radical question, but I'll ask it anyway.
Go ahead.
Has the time come for U.S. Treasury to issue 50-year maturity debt? And if not, why not? Might that also put a stake in the ground as to where we are with rates?
So I think that's a really interesting idea. I think it makes sense. What I would say is hopefully we're entering in a new frontier where more monetary policy topics are on the table, where more more creativity in terms of finances are on the table for governments. So I would say the time is ripe for a discussion on the 50-year. I think the one argument against it, if I were to make it, is that we're likely to see rates go lower over the course of the 50 years, so the government may not want to lock in that rate. Just given demographics. I mean, if you were to actually look at government yields since the 1800s, we're in a more normal state now than what we perceive as the norm, just because we look at through the lens of sort of the 1970s, 1980s through today. Yes?
So I feel like one of the reasons the economy is still okay is probably because of the consumer, and despite the PMI and the manufacturing recession we're in. And I feel that the consumer is in good shape because wage growth has just recently recovered to what I think it was before the GFC. And I think that's between 3.5 and 4. How much more wage growth do you think we can see before it's inflationary, before it starts eating into profits and just starts to diminish?
Actually, wage growth has been somewhat disappointing for this late in the cycle. In fact, we saw a little backtrack in the most recent labor data. So, so I would say that I think right now we're looking at an annualized rate of like a little under 3%. It could certainly go higher without really creating any kinds of issues. In fact, in Canada, we're seeing wage growth at like 3.8%, 4%. Over the last few months, so on an annualized basis. So I think there's definitely room to run, but of course that was a metric that Janet Yellen followed closely because she believed that was so tied to inflation. So we'll have to follow closely because it could cause the Fed to overreact a bit if they did see it go up a lot. But right now, that's what they're hoping for. Yes?
So typically, in the last year of a first-term president, it's good for the stock market because nobody wants to break it, including the Fed. With all the different dynamics going on here, is it different this time, or what?
I'm always reluctant to say it's different this time. But I will tell you, I think that certainly economic policy uncertainty is going up because there's so much in the way of question marks about who's leading the country starting in 2021, and every time you have Democratic debate, I think you see greater concern about what could possibly be depending upon who the candidate might be. So yeah, generally it's good, and I could see some factors being positive, but certainly we don't have a Congress that appears poised to spend a lot. So if that is our assumption in terms of why it's going to be a strong last year, that probably is going out the window. And also, the Fed is very split right now. I know we've seen 2 rate cuts, and we're likely to see another this year. But what we're seeing, and it really came out loud and clear in the interviews around Jackson Hole, and really in the FOMC decision from September, is that there's a lot of dissension, probably more than we've seen in years for the Fed. And there are question marks about how much more accommodation they're willing to give in 2021. Unless the economy goes into recession, I'm not sure they're willing to give any accommodation in 2020. In 2020, my Freudian stuff, in 2020. So I don't know the answer to that. History typically repeats. Well, I want to thank you so much for having me today. Hopefully this was somewhat helpful, and I really appreciate your honoring me with having me here. Have a wonderful day. Thank you.